Good afternoon, good evening, everybody. This is Stan from theartofchart.net, and Jack is here with me, and we're here to do a webinar. And the webinar is Trading in Volatile Markets. And we're here to talk about actually an outline, which I have here. I assume you folks can see that, and this is what we're going to cover tonight. Managing risk and volatility. I mean, that's what we're talking about. And really, there are 6 major points we'll talk through. And in terms of beginning, Jack, is there anything else you want to say to open? Because then I'm going to just explain the outline, and we'll start with the first item. That was the plan. So, anything from you?
Let's go straight.
Okay.
Let's just go straight.
Okay. The first thing about managing risk, folks, the very first thing is managing yourself. It's about the psychology of risk. Okay. Trading is an emotional game, or it can be, especially when volatility is present. And there is a destructive psychology that can get enacted, and there's also a very positive sort of trading mindset that you can coach yourself into becoming. Okay. I can show you a mechanical system. Okay. I can show you a mechanical system to help you manage risk. However, if you don't have your psychology under control, I'm sorry, a mechanical system to manage risk isn't going to help you. Okay, so that's why that's number 1 in my book. Okay, second is having a plan. Okay, you want to manage risk, you got to have a plan, and you got to have a system, and we'll talk about what that is. You also have to recognize, in terms of managing risk, market cycles. Okay, and there are different market cycles, and you got to understand as a trader, which of these market cycles do you do well in, and which of these can you not trade? And by the way, do you know what you can't trade and what you're not good at? Because as a trader, you need to know that, because you want the highest probability trades that will give you the maximum chance of success. Okay, that's what you always want. So recognizing market cycles and knowing, like for example, if you can't trade a correction, you can't trade a correction. So you look for consolidations and breakouts in trending markets. Okay, those are fairly easy to trade, but you got to recognize what market you're in, what market cycle you're in, because it has a lot to do with your capacity as a trader. Okay. Fourth, trading against a level, trading against something with appropriate size, and we get into position size here, and also managing stops and varying stops based on volatility. And then lastly, position sizing, which has a lot to do with risk and has a lot to do with volatility. So, and that's important. Those are just beginning talking points, really. And I think what I'd like to do is open up the floor to questions, and we're going to talk maybe for 30 minutes here. And then we'll open up the floor to questions. And as we talk, if you guys have questions, you have a question box that you can post a question in, please feel free to do so, and we'll get to the questions at the end. So shall we start with psychology of risk control, Jack? You ready?
Right. Yep.
Okay. Let's just kind of talk these through one at a time. And I have like 10 items here, okay? And the trading mindset, if you're a trader, the number 1 thing on my list, I feel like, do you remember the old Jay Leno show? You know, he went from 10 and he went back to 1 anyway. I feel like we're on the Jay Leno show here. But anyway, the number 1 thing for me, trading mindset, is not caring about money. If you care about money, it will cause emotion. Okay, so you have to be into like the process of trading, okay, the process of trading and enjoying the process of trading. I think that's really important. And not caring about money means winning and losing trades are equal from an emotional standpoint. Okay.
And actually, that's why so many people test things in virtual, do very well, transfer them into the real world, and do badly. In virtual, because it doesn't involve real money, they can trade it coldly,
right,
without fear of consequences. Now, what you have to try and achieve is trading it coldly in real life.
I think that's absolutely right on. And I think that underlying this, everybody's familiar with risk and fear and greed. So, I'm afraid to take a stop because I don't want to lose money, so I let my trade run, or I open my stop or whatever. But the trading mindset has a lot more to do than just fear and greed. Okay, so another one is for me, being open-minded. Okay, and for example, not having a fixed opinion. So like, for example, I love this. Today was a Fed day, right, Jack? Okay,
Yep.
so everybody has an opinion. It's like, okay, the Fed's going to come out, they're going to raise interest rates, and the market's going to go down, right?
Mm-hmm. Yep.
You're already sunk at that point from a risk perspective, okay? It's like always having a two-sided mindset and not caring one way or the other if the market goes up or down.
Also, the other thing is, everyone is an amateur economist on days like this.
Yeah,
But
right.
the reality is the professional economists do an absolutely awful job of predicting anything. A very good example is actually bonds in 2014. There was a poll of 75 economists, and they unanimously said that bonds were going to go down in 2014. I was trying to sell the opposite idea, and no one was interested. I'm not sure a single person took that long trade, and they went up enormously. Now, the reality is not only were they wrong, but they were stupidly wrong. Their whole theory was that, you know, QE3 was ending, therefore demand for bonds would go down, and therefore bonds would drop. And if that was right, then they would have done that at the end of QE1 and QE2 as well. And both of those saw big rallies. So the reality is they haven't even gone and looked to test their theory.
Yeah, absolutely. And that has to do with having a two-sided plan and being okay. It's kind of like this, flowing with the market. You know, you don't care what side you're on. You just want to be on the winning team. That's all you care about, right? And so when you start having an opinion about something, all of a sudden now your mindset changes and now you narrow what you see. Instead of seeing what's on the chart, you see what you want to see in the chart, and that's dangerous from a risk perspective. Let me throw out another one here, Jack.
A quick phrase on that. Seek, you will find.
Yeah,
if you
absolutely.
Look hard enough,
Jesus.
You will find the evidence to support your preconceived conclusion.
Oh, God Almighty, that is so true. That is so true. That's so well said too.
Yeah, but it doesn't mean it's actually there.
Yeah, right.
The reality is, if you look hard enough, you'll always find it.
Yep, right. The other one is, and I think this is a big one about a trading mindset. We're trying to start off on the positive side before we get to the destructive psychology side of trading, okay? But choosing an approach or a system and not being influenced by other people. And the number of traders that I've talked to on the side that says, oh, so-and-so says this, or so-and-so says that, or so-and-so, or I've searched Twitter and the dominant perspective is the Fed's going to do this and blah, 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 whatever. It's like people, I've noticed that traders tend to scour the internet for information. And then they come up with, oh, this is what the majority is saying. And either they do what the majority says or they do the opposite of the majority, okay, either way. But they don't have a system, okay, and they don't improve a system. And I know a guy, for example, who has been trading for years. He's lost over $1 million, okay? He doesn't have a system. He just follows other people. That's all he does. And so as a trader, you got to have a system that you rely on, that you develop. Can you learn from other traders? Sure, absolutely. Can you use information like we provide in our subscriptions to improve your systems or to inform your systems? Absolutely. But you should have your own system, okay?
Yes.
I guess the only thing is there's this thing that happens with traders. They get angry, and we'll talk about destructive psychology in a moment, but the thing about psychology is this: if you get angry, okay, you are probably opening yourself up to big difficulties in terms of being able to see the market. If you become emotional, whether it's fear or greed or anger or whatever, push away from the keyboard and walk away.
And walk away till you calm down.
Yeah, right.
If you've passed the point where you can trade cold, then you shouldn't be trading. Yeah,
I absolutely agree. Absolutely agree. And by the way, neither one of us are perfect at this either. You know, it's like a work in progress. We're all works in progress from a trading perspective. And the ability to focus on present reality, that's the other one. Like, what is the market doing now, this moment, which, you know, a few moments later, well, what's it doing now? You know, is it following the structure that I think? Or that I expected, or have we hit the level and is there support there, or is there resistance there, or whatever. So I think a trading mindset is always noticing what's happening now and sometimes even across the market. I think that's another aspect of a trading mindset. I'm almost running out of ideas here, Jack. I just want to throw out one or two more. Not caring which way the market breaks or moves. And this gets to trading cold, as Jack says. So today, did you care about whether it went up or down with the Fed? I didn't care either way. I was. I'm
I
sorry.
would
Go
have
ahead.
to steer play.
What's that?
I would have to steer play, but I wasn't feeling well today. I
Yeah.
don't like trading when I'm ill. But again, that's because you're not really. If you're gonna trade, you need to be in a reasonable mindset to trade.
Yeah. Right.
And the market's always there tomorrow if you're not.
Exactly. That's right. So that's what you want to try to develop, is that kind of trading mindset. That allows you then to manage risk appropriately. You're at a deficit if you can't control your own psychology. I'm ready to move to the destructive side of trading.
Yep.
Okay. Fear and greed are big here. The fear of being stopped out, or the fear of taking a loss. So what do people do? They open up their stop. And this has to do with ego. Okay. The number of traders that I've met, that I've talked to, that I've helped out of difficult situations. There's a guy I was helping out with an oil trade, and he was long oil. And I'm like, the dominant trend is oil is down, right? Why are you long? Because he's counter trend, right? And he said, well, because I thought it was going to bounce. That was his whole justification for being long. He didn't have a stop. He didn't have a plan. He didn't have a recovery plan. And so, if you have a big ego, you don't want to lose, okay? And that gets in the way of trading. It really does. Getting out of trades too early, anxiety, wishing and hoping, okay? Anger after a losing trade, where you get like into revenge trading. Just compulsive trading is another one, which is where you're trading 30, 40 trades a day, and you're sort of addicted to it, right? Excessive joy. This is a big one. When you're really happy about a winner, okay? You have a winning trade, it's a business transaction. That's what it is, and if it's a losing trade, it's a business transaction, and being able to see it that way. So those are some of mine, Jack. I just want to see what you have in that category too, in terms of destructive psychology.
Okay, the first, this is sort of halfway in between training mindset and destructive psychology. Understand the difference between analysis and trading.
Yes.
And this is really important. You can have a very good idea of where the market is going, and you can be absolutely right, and you can lose money on it anyway. Yeah, because it's not just a matter of being right about the outcome. You need to be considering where or not. Don't believe anyone when they say it doesn't matter where you enter. It's rubbish. It matters a lot where you enter.
It sure does. Absolutely.
Yeah. You minimize your risk with your entries. You try and avoid situations where you can be whipped out. You never chase, because the reality is, even if your thesis was right all along, you can lose a lot of money getting to the target that you had in mind from the start, just by actually trading it badly. So understand the limitations of analysis and recognize that trading is a different skill altogether. One thing that Stan was pointing out, when he was talking about over trading, one of the real problems for a lot of people, and we've all had this if we've been trading a while, is the feeling that you should trade if nothing is happening. And the reality is, this is where you're not doing anything unless you're in a trade. But the reality is, actually, you need to trade setups. You have a particular situation, you pick where you're going to go in, you consider where you'd get out, and you take that setup. What you don't do is just pitch in and put it on black. At the end of the day, if you're going to pass the time, in effect, by trading while you're waiting, then you're going to effectively spend all your time managing your crap trades from when you didn't have a setup, and you're most likely going to miss the ones where you did. It's at the end of the day, you need to be able to wait. Feeling that you're not doing anything by waiting is just wrong. The reality is, by waiting, you are helping yourself by waiting until you have a setup in which actually justifies having a trade.
Yeah.
Right. Another one.
And setups are two-sided, which we're about to talk about.
Yeah, they're always two-sided.
Right.
You have to. The thing is, even if you've got a beautiful setup and it looks perfect and all the divergences are right and the pattern setup's beautiful and God told you in a dream that it was going to happen, the reality is it can always go the other way. Always.
Yep.
There is no such thing as certainty. Not in the market, frankly, not anywhere else either. And if you're not aware of that, then you will take unacceptable risks because you know it's going to come good.
Mm.
And
that's
a bad idea. That's a really, really bad idea. And that's how people blow up. That's one of the ways in which people blow up accounts, and it's a really bad one.
Yep.
At the end of the day, people love to be right. It's very human to want to be right. It's not important to be right.
Yep.
It's important to do the trade correctly. And if you do the trades correctly and you wait for the setups, etc., you will make money. If you are right about market direction and you trade everything badly and without self-discipline, you'll lose money.
Mm-hmm. Absolutely agree. I think there are two sides to what you're saying. There's the how can I say this? There's the fear side of it, right? So it's like being afraid to trade. Okay, that's something that is very common. Like, for example, when we had that limit down day, people were petrified. They didn't have, and the reason I'm saying this is I think this is common when you see a big move or you see something you haven't seen before, and you become afraid. Now, my whole thing about that is you can overcome the fear, okay, of volatility by having a system. By having a system that you've used before, where you keep your stats, where you know what your averages are, and then even you can increase your confidence even more under volatility. We'll talk about this later, by reducing your position size. Okay, so if I'm risking less and I have a system that works, I can walk right into a limit down situation and trade it, which I did. Okay, in this last limit down. So, you know, I think that's the thing about fear is you don't have enough support. You got to build support for yourself as a trader. Otherwise, if you don't have that, there's nothing for you to lean on, and all you have is fear. Okay, the opposite is also true. That's not a good way
to make any decision.
Oh yeah, absolutely. The other side is the greed side. Okay, so this is where somebody puts on, and I know a guy that does this, right? He has like about $200,000 in his account, and what's his first trade? 80% of his account size. Why? Because he's overconfident and he's greedy, and he's like, I'm going to make a lot of money. I'm putting 80% down, right? And you never have a position size that large. You never do that. And by the way, he blew up his account, no surprise, right? But that's all ego and what I call being too sure of yourself. It's like, oh, this market can only go up. I can't lose money. It's like there's no respect for risk, okay, in something like that. So that's something else to just keep in mind in terms of destructive psychology and so forth. Anything you want to add, Jack?
I've got a few things on destructive psychology.
Okay.
There's, I think one of the ones is, I know I screwed it up. I know I screwed it up, and I know I was unself-disciplined, and I've definitely got to improve that after I've dug myself out of this hole. Don't do it. The reality is the cause of the problem is generally not the solution.
Yep. You're right.
Generally speaking, you're only going to make the problem worse. Really, if you can't get around this sort of mindset, then there's a promising career waiting for you at the Fed. It's where every problem has the same solution. The reality is, you know, if you've got yourself into a problem mainly through lack of self-discipline, which is what a massive problem for, and why huge numbers of traders fail. If you've got into a problem due to lack of self-discipline and lack of planning, etc., then panicking into a solution and saying I'll sort it out afterwards means that you're probably not going to have it afterwards.
Now,
or it's going to be a lot worse.
Yep. And that leads me to E, which is. And by the way, C and D we kind of all already have talked about. Mirror on the wall.
Hang on, you know, a couple more things.
Okay,
on that.
please do.
Just quickly. It's the market never ever owes you money.
That's right.
Revenge trading is a disaster.
Yeah.
At the end of the day, if you've had some bad trades and you're down X many handles or X $1,000 or so on, don't think that you should stay at the tables and win it back again. One, you'll be focusing on the money and not on the structure of the trade, so you're going to do it badly. Two, the market never, ever, ever owes you money. The reality is, you know, if you lost it on those trades, it's gone. Being unself-disciplined and chasing is always going to lose. Chasing, generally speaking, will lose. And it's really just chasing your losses. And generally speaking, all you'll do is you'll double it or even triple it. and it's a really bad idea to do it. The other thing is, and a lot of traders do this, I mean, we've all done this at one point or another, a paper loss is a real loss. If you are down, you know, 5 handles on a trade, and you won't exit that trade because that would crystallize the loss, and you don't want to make a loss. You've already made a loss.
Yeah, right.
What you can do by exiting the trade is you can move on to another trade, which isn't a screw-up. It's without having to lose another 20 handles and turning it into an investment. If you're thinking, well, it's a longer, if you turn it into a longer-term trade and you do that regularly, what you're doing is you're cherry-picking your worst trades to be your biggest.
Yep, right. So typically people that do that, they have this sort of thing. It's what I call the churn and burn trader. It's like I get a winner, I get a winner, I get a winner, I get a winner, and then I get a loser. But the loser is the one that I give it all back and I'm back to even. And people who trade for years and they make no money because they keep giving it back because of the lack of discipline that you're describing.
And another way to do this is to add to losers. To improve your average. Now I know people who do that very successfully, but the reality is, it's because they are very good traders. Most people,
they know how to read structure and they know how to read support and resistance, and they have a full awareness of price and the options and where price will come back. And if you're that good, you can manage to do that. But if you're not, I'm sorry, you're not paying attention to risk.
Yeah, this is it. I mean, generally speaking, if trade goes bad, get rid of it. Move on to the next one. Don't spend lots of time trying to save it. While you're trying to save it, you'll probably miss 2 or 3 decent trades that you would have made decent money on.
Right.
And probably more money than you lost on the one you were trying to nurse through. And the reality is, if your setup effectively, if you went in with a setup, a plan, etc., and it failed. Move on. Right. Some of them will always fail. Don't turn each one of those failures into your biggest trades.
Yep.
Because it's generally going to end in disaster.
Yep. So I think the point about the whole psychology piece here is you have to understand yourself and you have to coach yourself. So if you have any of these destructive psychology things, you might want to write them down, or write down one of them that you heard and say, what is my solution to this? How do I learn about this? Like if the fear thing is the thing, maybe you need to develop a system, whatever, okay? So I think looking at that is important. Ignoring that, and by the way, if you're an experienced trader, you know what we're talking about. This might be a good review for you, but if you're new to the game, this is a big deal, okay? Now, having a two-sided plan. If you want to manage risk, you got to have a two-sided plan, okay? And if you're walking into a trade without a plan or without using a system, then you got problems. And I want to show you maybe an example on a chart of what a two-sided plan might look like, okay? And a two-sided plan, typically you have 3 parts to a plan, okay? You have the entry side of the plan, okay? And you'll know where you're wrong, okay, on the entry. It's like, you know, I'm going to enter here, and then my stop is going to be XYZ. We'll talk about stops in a minute, okay? Then you have a way of managing size in terms of the amount of money you're putting on, but also how you're taking it off, how you're taking profits as you go. And then you have an exit plan, okay? And how many traders here actually have the following issue? You get out of a trade, you make maybe 5 or 10 handles, whatever, maybe 20 handles, whatever, and the market keeps going, and it goes another 10 handles, and you say, oh God, I screwed that up, okay? If you executed your plan, you should be happy, right? You should be satisfied. Hey, I'm happy enough with the trade. So let's look at like elements and basically what I'm describing is a system to you, okay? Okay, so here is a chart of the S&P 500. Let's just talk about managing risk and volatility, okay? Now, when you're in a period of volatility, like what we've had here, and this has been a period of volatility, what do you look for? You look for areas of support and resistance, okay? So for example, right here is the monthly pivot, which we talk about a lot, right? You can see the monthly pivot really was resistance here. We didn't quite get to it there. It's resistance here, et cetera, et cetera, et cetera. So an example might be, for example, we made this call to call this area as a possible area of resistance. So if you had a plan to trade this, for example, the plan would be, I'm going to put something on at the monthly pivot. I'm going to set a stop based on ATR, average true range. Okay, now let's just take a look here. At this point in time, average true range on, this is the S&P 500, was 10 handles. okay, 10 points. And so at that point, what you would do is you would put on a 20 or 30% ATR, okay, in order to make that trade. Now that's very different than this trade. Jack and I called resistance, we called resistance right here. What happened? We broke through that resistance. It was a big break. And then it came up and it tested it and it came back down. Now, if I were trading this right here, I trade it completely differently, okay? Because here we are, we're bumping up against an area of resistance, right? But look at where my ATR is. My ATR is at, what's my ATR here? Let me just check. My ATR here is 37. Okay, so a 20 or 30% ATR there is a heck of a lot bigger. So, you know, I have to manage my position size when I get into a trade with my ATR that large. Otherwise, I get stopped out a lot. So, you know, if I'm looking at an ATR here of 37, I'm trading with at least a 7-handle stop. Okay, if I'm going with a 30% ATR, I'm looking at a 12-handle stop in that kind of market. Okay, and that's part of your plan. You got to have a two-sided plan. Now, the other side of the plan that I'm not talking about is, okay, let's say I take the entry here somewhere when I get up in this area, right? And I set my stop, which is a 12-handle stop. Okay, what do I do if it reverses? Okay, I wait for it to reverse. I get stopped out. I wait for the pullback, and then I get long. Okay, look at what happened here, right? You might have come up here. You might have said, okay, I'm going to trade against the monthly pivot. So I will make my trade. I will look at ATR because ATR is a indicator for volatility. All right. And so I would say my entry here, let's see, my ATR is roughly 5. So I'd go with a 20 or 30% ATR. I'd set a 2-handle stop. I just got stopped out. Boom. Okay. Now what do? I wait for the back test. There's the back test, and I get long. And what do? I set my stop below. Now here's something I want to say about this. You do that once, guys. I had a guy send me an email. It's like, yeah, I tried to trade the monthly pivot today and I tried to get in 5 times and I couldn't get in. It's like, you don't do that. You do it once. If you fail, you fail. You wait for the next setup. You don't just put trades on to put trades on. So that's sort of the plan side from an entry perspective, right?
Also, just about that one. What you can do actually, if you keep chasing a particular trade, is you can manage to turn. Let's say your normal hit rate would be 3 out of 4 on setups. Yeah. What you can turn is your one loser. You can turn into 5 or 6 failed trades.
Yeah. Right.
Whereas there's no multiplication of your successful ones, so you can actually kill your average entirely by chasing things. Generally speaking, a bad idea to chase.
Yeah. So again, two-sided trading is we know where we're going to from a resistance or support standpoint. We know what the ATR is, so we can vary our stop size based on volatility. Based on volatility, we vary our position size. So when I made this trade right here, for example, okay, actually, yeah, it was this trade right here. What I did, if I remember correctly, let me see what I did. I was trading 1/2 of my normal position size right here, okay, because of the size stop I had to set. And so that's what you do as a trader. You adjust your position size, okay, based on volatility. Now, the other thing about trading is exiting, okay, and that's something else we should talk about. So, like this week, let's go to the E-mini, Jack. If you remember on Tuesday in the Princeton Trader Room right here, I think I put a post in and you were like agreeing with me that if it goes below 35,
yes,
you know, that there's going to be a break, but we're seeing a reversal pattern, right? And we were at like 40s. So, you know, you put on a long, you set your stop below, okay, based on volatility again, okay, and you can see what the ATR was right there at that point. It was 6, so my stop was 2 handles, and you let the trade go. Now, you get up to the monthly pivot, what do? You take off a third, okay? You take off a third of your trade. It gets through the monthly pivot. Maybe you get up here into this area, you take off another third. You're heading into the Fed meeting, what do? You punch out, or you make your position small, your position size very, very small. Why? Because you've already made a lot of profit. I mean, why do you want to keep big size on? I mean, you know, you take off a third rather quickly, you let your second third run, and then you leave your trailer on and maybe even shrink it especially when the market gets more and more volatile. Okay, so that's the other side of trading, is exiting. But exiting isn't exiting at a number. Exiting is exiting in certain percentages. You take off 25%, you take off 50, you take off 75, etc. So that's the other side of exiting, is and ratcheting up your stops as you go. Okay. So what I just sort of did, Jack, just to save a little time, is elements of a plan. Okay. And what is a system? A system, you have entry criteria and you have exit criteria. You know where you're wrong. Okay, whenever you enter a trade, you know where you're wrong and you take your losses. By the way, trading is about both taking winners and losses. You got to be able to do both.
Yes. If you can't take a loss, then your losses will become your biggest trades and wipe out your account.
Yeah, absolutely right.
So kind of more personal.
Anything else you want to bring up on number 2? Elements of a plan?
No, I don't think so. I mean, the support and resistance levels is particularly important. I mean, that one we were looking at 35/6. We'd had a test the previous afternoon, I think, and it came back and retesting blowbacks. And what you're looking at there is the formation of a floor.
Yeah, exactly. Right.
And that's why Stan and I were saying, if we break under there, then it's all over and it's going down. But I mean, if that holds, then we've got this bull scenario which could play out and so on. And that is a floor. That's an important level. It's a tested level,
right?
A demonstrated level. And the reality is, levels like that, levels that perform like that, and you can see, just throw some moving averages on a chart and have a look and see which ones are the ones that matter. Because it will become obvious pretty quickly on any instrument.
And to be honest, this is against it. See, this has so many multiple things going on. There's trend line support. We have a 3 down. It's an inverted head and shoulders. If you go down to a 5-minute chart, it's like there's so many signals all at the same time, So it's like, wait for the quality setup. I think that's the key message in volatility, is you'll get big trades in a volatile market, right? Wait for the quality setup. Okay, yes. I think that's really important. Recognizing market cycles. Now, this is more for advanced traders. Okay, those of you who are advanced traders, you have a system. Well, how does it perform in a trending system? By the way, it doesn't perform the same as in a consolidation kind of a market cycle, right? And also, how does it perform in breakouts? And how does it perform in a corrective market cycle? So do you know how you perform in different market cycles? Okay. Now, to recognize market cycles, number one, you have to recognize it on a chart. But the other thing to recognize is you have to keep a documented record of your trading. Okay. And just to talk about that for a second, here are some things that I think are critically important to document. Okay. Because otherwise you don't know how you trade against these markets, right? So your win ratio and your payoff ratio, okay, like your wins divided by your losses, okay, are you 3 to 1 or whatever? And the other thing is to track, what's my largest winning trade, what's my largest losing trade, okay, and what is my target? This is my favorite thing. What's my target max drawdown for the year, given my account size? What's my maximum drawdown? What's my max drawdown for the year? And do I manage my trades to always, I never exceed my max drawdown for the year. So if I set a goal that for the year, I will never lose in any one trade more than 2% of my account, if that's my goal as a trader, okay? Am I hitting that goal? And then I would ask myself the question, why am I over that? Okay, why am I past that? Because if you're past that, then you have a big problem. So you got to keep stats on your trading. What is your biggest drawdown? What is your average drawdown? What's your biggest losing trade, your biggest winning trade, and then your average winner and your average loser. Now, there are plenty of tables on the internet where you can look at how are you doing in terms of risk and volatility, and what percent of your account can you risk based on your percentages. Okay, like for example, if I'm a 6 to 1 trader, in terms of my payoff ratio and my win ratio, well, I can risk more. Okay, I can risk maybe 10 to 15 to 20% of my account size. Okay, if I'm a 2 to 1 trader in terms of my winners versus losers, okay, I'm looking at maybe a 5% of my account size wager. okay? So keeping these stats, first of all, helps you to recognize market cycles. But the other thing it does, with the appropriate tables for risk, it helps you determine what your ideal position size is. And so just a quick comment on position size. We've talked about position size here, legging in and legging out, okay, to manage risk, right? There's a 2% rule for any one trade. You shouldn't lose more than 2% of your account size, okay? Because if you have, like, how many consecutive losses do you have in a row? If you have 6 or 7 losses in a row, well, if you're losing 10% of your account size after about 3 consecutive losses, you're in trouble, okay? So, you know, losing 2% is the kind of rule. Maybe you stretch that to 3, depending upon your account size. But guys, you should have a limit in terms of what is my rule in terms of maximum loss, okay? And then the 20% rule basically is, what is the maximum that I will wager on a trade? If you don't wager any more than 20% on a trade, you will be able to manage it, okay? If you wager more than that, you're inviting anxiety and you're inviting fear. Okay, and you will not execute at your best if you do that. So typically what I do if I'm into a 20% trade, by the way, first of all, it's a great setup. Second of all, I'm legging in 1/3 at a time. I put on a third, I put on a second third, and then I put on a third third. And then I let the trade go. Sometimes I only get 2 legs on, and that's fine, you know. So I'm just trying to summarize what we have below here, Jack, because I want to open up the floor to questions here. So
I wanted to quickly talk about breakouts.
Yeah, please.
All right. One thing to consider, I mean, I post an awful lot of patterns, rising wedges, falling wedges, triangles, etc. And the question is, if you, and this is something I've seen an awful lot before, and I've had a lot of questions on it before, and it's always worth repeating. If a falling wedge breaks resistance, do you pile in? No. You can put pass on, ideally around a level with a stop, or if you're going to do it with a long stop or no stop at all, you need to give it some space. Well, the reason is, and you need to also keep back most of your trade for the better entry. Now, generally speaking, you will get a better entry. What does it always say about breaking out of a pattern? You break out, you form the reversal pattern.
Exactly.
As often or more often than not, that's going to be some kind of retest of the low. So if you are some way off that low when you break out of the wedge, which would be usual, then if you're actually going to hold it, when it retests that low, it's really going to hurt.
Yeah.
These things don't normally just head straight to the target. If they are going to head straight to the target, you will generally already see the reversal pattern clearly. So consider it. Never ever underestimate the power of the retest. Don't go in, it's a bull break, pile in, and you will get murdered.
Here's a great example of that. I mean, talk about what you were just talking about, Jack. Okay, so here we are in oil, right? Oops, sorry,
Yep.
Let me expand this. Okay, and what we were saying in oil is we have a level here, which is the 100% level. We have this trend line. We have this triangle, an A, B, C, D, E. And we were saying wave B is here, right? And we were saying watch for the impulse higher. Okay, so we get to this 100% level. We get to this trend line, and it pauses, right? It breaks out. It comes back, and it back tests that trend line, and then it goes. Okay, so that's a great example of what Jack's talking about, which is.
Could you throw me the screen? I'll actually show them what this particular example looks like.
Yeah, sure, absolutely. Here we go.
Actually, I just did the chart for that.
Right.
Right. Okay, hang on. Now, this is actually a very, very good example of what we're talking about, and I've just done the chart for it because I'm going to be using it on the video later tonight. Let's have a quick look at it. This is using USO as a proxy, which is a pretty good proxy for CL, and I don't have. I use stock charts mainly because I have thousands of charts saved, and normally you can't save lots of different variants of a chart. Now this is the triangle. It is broken up. What's happening now? Now Stan was saying expect a retest on the video this morning, and what have we got here? We've now got a 15-minute sell signal. We have a little head and shoulders, which is mostly formed. We have, and this is worth noting for what we were talking about, support and resistance levels, we've got support here at this moving average. But if you sorry, but if you have a look at the target for the head and shoulder pattern, you can see I've pointed with arrows what I think is probably going to happen here, and that is we're going to retest there. This is not your best entry. This really isn't your best entry.
Yeah, right, exactly.
This is your best.
Yep, exactly.
And you need to make sure. I mean, sometimes it'll run away. I mean, and you don't chase it because sometimes it just runs away. What you have to do is play the odds. Normally, there will be some kind of a retest. You can see it's not that hard to spot a head and shoulders or a double top or double bottom or whatever. It's you can see whether they're there or not, or whether they're likely to form most of the time. But here, that is laid out. Chances are, I mean, that's not necessarily going to happen. Nothing absolutely has to happen, but chances are that's likely to play out. And down here at the retest is your ideal entry.
Right. So as volatility increases, okay, what you want to look for is you want to look for setups, and you want to look to trade against something. So like the example here that I showed you, do you see how we kind of broke through and then we back tested and then we went, right? Trade against something. So you trade, like for example, if I were, can you put your cursor on the lower high there, Jack? In that head and shoulders there at
this one here.
Yeah, right. So
yeah,
like
these are very good entries.
Yeah.
If you think a head and shoulders is forming, you know, because the thing is, generally speaking, I mean, not always, and you do see ones where the shoulders aren't comparable, but actually an awful lot of the time they'll be in very similar areas.
Yeah,
the tops
right.
of the shoulders. If you can see a pattern forming, and this one Stan called before this even started forming this morning. It's or at least at an early stage. It's and realistically, ideally, you were looking for here.
Right.
Not a bad entry.
So what you do is you put a position on, right? But you trade against something. What are you trading against? You're trading against the high, and you put your stop above the high. And by the way, if you're wrong with the setup, you're wrong, and you take your loss, right? So always trade against something, whatever it is, and based on the amount of ticks, of course, you adjust your position size. So if I have to put on an oil trade and I have to use a 20 tick loss, stop loss, that's very different than a 70 tick stop loss. Now, the other thing about trading volatility, and this is important, is knowing when to take off size and knowing when to put on size. Like for example, I don't know if any of you trade a thin market like RBOB, right? But a very good way of trading RBOB is to, okay, you have a certain level, like right there, that you think it's going to work. You put on a small position size, 20% of your normal size, whatever that is. Your normal position size might be 6% of your account, right? So you put on 2% of your account, right? You wait for it to break that trend line that Jack has there in purple. Then you put on another 2% of your account. And as it starts to run, maybe there's another trend line in there, let's just say, and you add on the other 2% of your account. That's actually very good risk reward, especially in a highly volatile market, is to add to your trade as it progresses, as it crosses levels. And then, of course, as you get closer to like the trend line that Jack has there, legging out. So legging in and legging out, I think, is a key thing, and a lot of folks just don't do it. You know, they're waiting for their target. And, you know, I think the key thing to trading in volatility is just being on the right side of the market. If you're on the right side of the market, that's 80% of the game.
Yep.
Okay, I think I'm looking at the outline, Jack. Position sizing, volatility, managing risks, managing stops based on volatility. We've covered the outline. Let's see if folks have questions. And I'm going to pull up the question tab. And we have...
I'll share the screen back to you.
If you want to, sure. Anybody attending have a question about risk management and volatility? Let's see if folks have questions. We're going to give folks just a few minutes and see what they have to say. Okay. Have you found that legging into trades is more challenging? That's from Brent. I think every instrument, Brett, is different. Okay, like I trade RBOB very differently than I trade ES. okay? So ES, if I'm doing a swing trade, typically I'm putting on a 6% position size. I use 6% in legs. So I'll put on 6% and I'll let the trade go. I'm either right or I'm wrong, okay? And I typically don't add an ES. I add in markets that are volatile, okay? Like for example, the oil trade that I just showed you. Hell, it's right here. Let me just show it to you. This would be an example of where I might do ads, okay, in terms of legging in, right? So right here, for example, at this 100%, I might leg in long, okay, because I know or I have a hunch that it breaks this monthly pivot. It's going to go. And I set a stop above, okay? I'm sorry, a stop below. I might set my stop all the way down here, for example. So I'm long, let's say. We break through the monthly pivot, I add to my position. Up here, as the market starts to top out, and what I would watch for is divergence, okay? Here's a key sign, guys, to watch for. If I see divergence like that on RSI, on an hourly chart, I'm legging out of my trade. If I see this, I get out of a third. If I see this, I'm out of 2/3. And then if it declines below a certain point, I'm out of the last third. So, you know, legging in and legging out and using indicators to help you leg in and out, I think is key. Okay. How do you use Bollinger Bands from Fred? You want to talk about that, Jack?
Yeah, sure. Well, okay, the basic principle of the Bollinger Band is very simple. Sure, you're all familiar with it. I'll just repeat it quickly. You've got any time frame, you've got the 20-period moving average, which is the middle band. And then the standard Bollinger Bands are 2 standard deviations beyond that. And those are... The 20 MA tends to be a good support and resistance level anyway. It's a very good marker. I mean, if you read my posts, then you'll notice I'm often talking about resistance at the middle band, support at the middle band, a break, a type of reversal of that break. I was talking about that yesterday. If you saw a rejection, you'd normally see most or all, etc. So that is an important level in and of itself. The standard deviation, you've got to remember, it's not just the fact that there's 2 standard deviations away. Everyone's watching it. Yeah. Everybody's watching it. This is a very, very widely used market tool. The fact that everyone's watching it turns into a significant level of support and resistance. Very much so. It's if you go through it, I mean, we've talked in great detail about band rides, I think on many posts of ours. Sorry, and it's just you know, the tendency once you become embedded on a band after a couple of days to often just continue a trend down it. And how to take advantage of that. I mean, there are many ways to use bands, and they're one of the most useful tools there is. And one of the ones I was talking about a month ago was actually putting on a second lot of bands, which are the three SD Bollinger Bands, and those are very useful for showing you when you have an extreme level being reached.
Yeah, right. And very often too, and just to add to that, very often too, what happens when you penetrate the second standard deviation Bollinger Band, if you're in a corrective market, it tends to stay below it. It'll trade in a channel between the second and third standard deviation Bollinger Band. That's something to watch, okay? And that actually happens. Yeah, very tradable, right? In volatility, that's something to key on. One thing to add to the Bollinger Band comments, there's something called a pinch in Bollinger Band trading. So like, here's a pinch, right? We had an expansion and there's a pinch. And a pinch in a Bollinger Band is sort of like, we're about to make a move. We're about to get an expansion. You get an expansion. Look at this expansion. Whoosh. Okay. Look for another pinch. Here's another pinch. There's an expansion. Whoosh. Okay. And so if you do nothing but look for pinches in Bollinger Bands and have a system, okay, for trading it, okay, you get big bars. Like this one here is a great one. Nice pinch, big bars out of a Bollinger Band, right? The other thing to look for that's very, very tradable in terms of volatility is look at RSI. Okay, here is RSI, and look at this. A triangle in RSI typically is accompanied with compression, right? What do you get out of compression? You get an expansion, right? That's how you make money in trading, is you wait for compression and then you play the expansion, or you wait for an extreme to be hit and you trade that as well, okay? So that's the answer to Fred's question. Brent, I think we answered your question on the E-mini, I believe. Okay, so Frank has a question. Is your RSI simple Wilder, weighted, or exponential? This is a Wilder, I believe, the 14 that I use. I'm not sure, Jack, if you want to comment on that.
I'm actually not sure which one mine is. It's just the standard default setting on stock charts.
Yeah.
I've never actually checked.
There is a difference, Frank, and I tell you what, it's really important too, because simple gives you completely different results from a Wilder.
I could find that out easily enough.
Okay, cool.
That's,
let's see if we have other questions. We have about 6 minutes left. We said we would take an hour. Anybody else have questions? Okay. Well, everyone, ladies and gentlemen, thank you for attending. We wanted to at least start doing some education and on the site. And the reason we're doing this, frankly, is we get lots of emails from people saying, I'm having a problem with this, and I'm having a problem with that, whatever. And a lot of it has to do with risk management and being able to manage risk and being able to manage trades. And the one thing we have not talked about, Jack, is trade repair. And that's more of an advanced topic. But I think maybe
I think it's sufficiently advanced that most people are not advised to try it without some real testing. Ideally, testing which was done without using real money.
Yeah.
And that is actually one other thing that we haven't mentioned today, but is worth mentioning. So if you have a strategy, if you possibly can, test it in virtual.
Yeah, absolutely right.
You will trade it cold because there's no money on it. And the second thing is, if it's going to fail, it's not going to cost you money.
Yep, right. So if you develop a system on ES and you want to graduate to oil, I would suggest you do it virtually first, okay? And if you want to do grains and even more advanced instruments, you better do it in virtual first because you can really lose your ass pretty quick. Anyway, anything else, Jack?
I think I'm looking at the Stock Charts website. I'm pretty sure it's the Wilder.
Yeah, okay, great. I prefer the Wilder myself. Okay. Folks, thank you very much, and thank you for attending. We're going to do one of these every week, and I hope you guys find this valuable, and thank you for attending. Everybody take care. And Jack, thank you very much. I enjoy doing this with you. Take care.
Yeah, likewise.
All right. Take care, mate.
All right. Cheers.
Bye.